Alright, so today I wanted to make a video about a stock that I haven't talked about in a while. I have talked about it before, and the reason I wanted to make the video is I think it's one of the more undervalued positions that I'm currently buying, so that's the reason. First things first here, if you get value out of the video, please like, subscribe, check out those links below. Very much appreciate the support. So getting right into it here, just under $18 billion market cap, dividend yield just below 1%. 4.3 free cash flow yield, a little over 7% earnings yield. Engages in the design, manufacture, distribution of building envelope products and energy solutions, headquartered in Scottsdale, Arizona. So again, they're construction materials, weatherproofing, that kind of stuff, roofing. Pretty. I mean, it's not an overly complicated business, and I think that's a good industry, right? Because if you look at the U.S., which is obviously where they're mainly dedicated to, it's a growing population, right? The demand for housing is still there, and not only that, a lot of people are locked into, low fixed rates mortgages that are not going to be expiring for 10 or 20 years, and rather than buy a new house, they simply remodel their new house. Maybe it's a 10 or a 20-year-old house, and you need a new roof, you need a new this, you need a new that, and this company is going to benefit from that too. So let's get right into the metrics and the insights here. Profitability is good, right? I mean, 37% gross margin, 22% operating margin, 25% net margin, 15% free cash flow margin. Those are all good. Management's doing a good job. They're outperforming the S&P. Their growth right now is slowing, but personally, I think that's more or less due to a slowing economy, right? I mean, the economy will bounce back, and I think that a company like this will bounce right back. And the reason I say that is they beat the S&P over the last 5 years, over the last 10 years, over the last 3 years. Like, over the long run, this company consistently beats the S&P. Current ratio of 2.5, that's very good. They're buying back shares quite aggressively, which I also like. The dividend I'll get into in a little bit. Earnings are projected to go down, and I think that's reflected kind of in the growth slowing a little bit here. But again, analysts are still bullish. The company is still growing over the long run. And not to mention, too, like earnings and profit and their growth is coming down a little bit, but the company is trading 29% below its historical PE. So the company, like the lack of growth right now is, I think it's priced in. I think it's priced in, and it's going to go back up. If you look at this company's 1 year chart, it got hit really bad, back recently. I mean, it was down to about $3.17 a share at one point, and it's up almost 29% since then. It is still down quite significantly from its all-time high. It's down about 15-ish% since then. I'll get into what I think is a fair value for this company soon, but I think it was definitely a little overvalued there, but I still think it's undervalued where it's at right now. So if we look at this company here, over the last 10 years, they've grown earnings almost 22% per year. They've bought back almost 4% of their shares. Free cash flow margin has gone up, or their margins have gone up. Their net margin's up. Their operating margin is up. So this company has gotten more profitable as time goes on, which is obviously a very good sign. Return on equity has gone up significantly. Revenue's grown about 8% per year. And even though all of their numbers have gotten better, their compounded annual growth rate to their PE has gone down, right? I mean, the lowest their PE has gotten is about 10. The highest is about 30, just under 31. This is a company that, I mean, let's go back even to the last 5 years. They've grown earnings 28%. They're projected to grow earnings about 12, 13%, I believe, over the next 5 years or so. So, I mean, a company that's going to grow their earnings, if they're going to grow at 12%, honestly, like a 15 to a 20 PE probably is more reasonable. That's a reasonable valuation. And if they're currently at 14, that definitely implies they're undervalued. So that's what I'm saying there. So let's check out the dividend here. If we look at the dividend, they've actually grown it they're actually growing it faster over the last 3 years than they have over the last 5 years and 10 years. The payout ratio is just under 14%. So I think they're going to be able to continue to grow their dividend probably 15 or 20% per year if they want. Like the payout ratio being 14%, they're easily going to be able to do that. Let's check out their numbers here just to kind of gauge things a little bit deeper here. If we go over to the income statement, revenue definitely came down a little bit. Like, I mean, if we go back, let's go back about 10 years. Revenue peaked back in 2022, even 2023, but it's kind of started a very slow uptrend by the looks of things here, going back about a year and a half. To me, it kind of depends. If we see a recession, I think that number probably drops. But if we don't see a recession, it probably trends back up. Shares outstanding is kind of a thing of beauty here. They probably bought back a quarter of their shares over the last 25 years or so, which is probably where that insane earnings growth came from, or at least earnings per share. Earnings per share, again, it's very close to an all-time high, even though it has kind of petered out over the last year or so. But I mean, if you go back a decade, the earnings per share has gone up like 6x, 7x. Even 5 years, it's up, almost double. So I'm not concerned there. I still think we're going to be okay. Let's get into the valuation here just to kind of gauge where I think things are going to be at. So I'm projecting them to grow earnings at 10% per year, which is less than the 20-ish% they've grown long term, and less than the 12 or 13% that they're projected to grow at. I'm projecting them to buy back 3% of their shares per year, which is less than the roughly 4% that they've done over the last decade. They're going to grow their dividend at 14%, which is less than what they've done over the last 3 years, 5 years, and 10 years. And they're going to trade at a 13 PE, which is less than they currently trade at, and quite a bit less than their long-term averages. That still implies that they're about 12% undervalued, and their compounded annual growth rate would be about 12.5%. I would say that, $4.50 a share, $4.50, $4.60 is about fair value. Once they get up to, a 17 PE, that's probably, 17 or 18, that's probably roughly what I would say is fair value. And if they're currently at 14, 15, that implies we still have, 10, 15% upside to go. So long story short here, I think you're, in my opinion, obviously my opinion, you're safe to buy this company up to $450 a share. That's probably where I would stop, and I would wait for a little bit of a pullback. But this company, like, if we don't have a recession and if things really turn up, they could rip up to $500 a share, like, really easily. I mean, they're up, in the last 6 weeks or so, they're up from 317 to $400 a share, right? Like, they could go up another 80, from whatever they're at, like 410 roughly right now. They could go up to 480, 490, 500. Like, they could do that in a month or two. Like, that's not out of the realm of possibility. So, like I mentioned, I do like this company. I think it's a good industry, and I mean, historically they've done really well, right? Historically they've done really well, and this is when you want to buy companies, right? When they're in a little bit of a downturn, that's when you want to get in. Like, that's really when you want to get in, and not to mention too, like, they're an American company. Like, they have everything to gain when it comes to. They're not really facing any tariff issues, right? That's one benefit they have as well. So I do like them. But again, the one thing you have to keep in mind is, the housing industry, it is definitely cyclical, right? I mean, if there's a pullback in the economy, they will get hurt a little bit. But at the end of the day, there are structural shortages when it comes to housing, right? There definitely are. And companies like this will benefit over the long run, right? So I think you need to be careful about your entry point. I think it is a good entry point still where we're at right now. But again, you don't want to overpay, right? You really don't want to overpay, right? The key to investing, in a nutshell, is you buy good companies for a fair price. Or preferably, a better way of putting it is you buy good companies at a discount. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, comment, check out those links below, and stay tuned for more.